The History of American Banking by Irene Lee and Jessica Martin. At an unsure time, people turned towards their leaders to stabilize their economy. The two parties that fought about the establishment of a central bank were the Federalists and Anti-Federalists. The Federalists were led by the Secretary of Treasury, Alexander Hamilton, and the Anti-Federalists were led by the Secretary of State, Thomas Jefferson. The National Bank was part of Hamilton's financial plan to pay off the debt that America owed Britain. With this plan, Report on Public Credit called for the federal government to pay off the national debt at face value, also known as funding at par, and assume the war debts of the states. Hamilton supported the high tariffs and excise taxes. This would protect American infant industries from foreign competition and raise revenue to pay off the debt. The National Bank was created with the goal to help create a stable, healthy economy and currency. There was a huge debate over the Bank of the U.S. and the power of the federal government under the Constitution. Jefferson claimed that the bank was unconstitutional, which fell in line with the Anti-Federalist belief of a strict interpretation of the Constitution. However, Hamilton claimed that the bank was necessary and proper. This worked in hand with the Federalist belief of a loose interpretation of the Constitution. Ultimately, Hamilton won, and Washington reluctantly signed the bank into law. The first Bank of the United States was created in 1791 and held a charter for 20 years. Within 2 hours, the stock for public sale oversubscribed and obtained a capital of $10 million. The first Bank of the United States did wonders to stabilize the American economy, but the Anti-Federalists still opposed it. People feared that it would only help the wealthy. Hamilton died and its charter ran out without renewal. Since the charter for the first Bank of the United States had run out, state banks were left to issue unbacked notes. They printed more money than they could back, which caused rapid inflation. Different banks issued different currency, and the citizens had no confidence in the value of their money. In 1816, the Tariff of 1816 was the first protective tariff designed to help American industry and manufacturing. The Second Bank of the United States helped ensure financial stability and provide credit for the next 20 years. Money from the bank helped in the development of canals and roads to link the nation together. Nicholas Biddle was an American financier who served as the third and last president of the Second Bank of the United States. He helped restore stability, he shut down banks with more notes than gold and silver to back it, and he taught other banks to be careful of the amount of notes issued. Andrew Jackson was the president to follow. He was known as the King of Vetoes, and because he distrusted federal banking power, it was no surprise that he vetoed the renewal of the bank in 1832. Since Jackson refused to renew the charter for the National Bank, state banks and his pet banks began to collapse everywhere, and it resulted in the Panic of 1837, which was caused ultimately by the Wildcats. The Specie Circular is a United States presidential executive order issued by President Andrew Jackson in 1836 and carried out by his successor, President Martin Van Buren. It required payment for government land to be in gold and silver.
By 1860, over 8,000 banks were circulating their own currency because the federal government did not provide a national currency, nor did it regulate reserves. Under Van Buren, the divorce bill made money that was stored unavailable, meaning that federal money was stored in a separate bank vault, so it would not be connected with the ups and downs of the federal economy. The Civil War, starting in 1861, worsened these issues. During the Civil War, both the Union and the Confederacy needed money to provide for the military. In 1861, the U.S. Treasury issued the first paper currency, officially known as demand notes, but informally called greenbacks. Meanwhile, the Confederacy issued a cotton-backed currency in hopes that victory would ensure its value. Contrarily, this Southern currency became useless as its economy suffered under the strain of war. The National Banking Acts of 1863 and 1864 granted three important powers to the central government. 1. The power to charter banks. 2. The power to require banks to hold adequate gold and silver reserves to cover their banknotes. And 3. The power to issue a single national currency. This new national currency led to the elimination of other state currencies, which stabilized the country's money supply. In the 1870s, the nation adopted a golden standard, which is a monetary system in which paper money and coins are equal to the value of a certain amount of gold. This had two advantages. It set a definite value for the dollar. For example, 1 ounce of gold could equal about $20. Since the value was set, people knew that it could redeem the value of their paper money at any time. Confident in that knowledge, people felt comfortable carrying around the lighter and more convenient paper money. Another advantage was that the government could only issue currency if it had the gold to back it. Because of the limited supply of gold, the government was prevented from printing an unlimited number of notes. The gold standard fulfilled an essential requirement of a banking system, a stable currency that inspires the confidence of the public. In the early 20th century, some reforms include the national currency, the gold standard, and a stabilized version of American banking. However, there is no decision-making authority to provide funds for growth and manage money supply for economic needs. The Panic of 1907 saw people stop exchanging their gold for paper money as New York banks failed. Because of this, businesses did not have access to money for investment and growth, and therefore widespread unemployment occurred. There were plans to reinstate the central bank. 1913 saw the rise of the Federal Reserve System, which created the first true central bank. A central bank is one that lends to other banks in times of need. It also reorganized the federal banking system. This system comprised of 12 regional Federal Reserve banks that were chartered by the national government. Member banks belonging to the federal government could deposit their reserves in their nearest regional bank. Each bank was supervised by a Federal Reserve Board appointed by the President. These reserve banks had the power to make short-term loans to member banks to prevent bank failures as caused by things such as panics. They also had the power to change the amount of circulating money in the economy. Throughout the 1960s, banks were closely regulated by the government. They were restricted in their interest rates and the amounts they could charge for loans, and they could only loan to credit-worthy customers. However, banks became tired of this, and gradually, government began deregulation.
During the Roaring '20s, investing in the stock market became a national pastime. The Great Crash of 1929, also known as Black Tuesday, was caused by many factors. During that time, there was a lot of credit and loans being encouraged. Many people were actually borrowing more money to buy shares, and therefore many people were in great debt. Credit had become too popular amongst the people, and the majority of the people were buying on the margin. This means that they only paid a small amount of the shares and were borrowing the majority of the money to buy shares. When the stocks fell, these people got wiped out, and banks and investors who lent them money were also affected. On Black Thursday, Dow dropped 11% upon opening of the market. This alarmed many stockholders, and people started to sell their stocks like crazy. This panic spread and led to massive amounts of people withdrawing their shares. This caused a further spiral downwards in the stock market, leading to its eventual crash. Banks gave out large loans, but companies could not pay them back in the end. Haitian farmers were also unable to repay the loan they borrowed for their land due to failure in their crops that year. The stock market crash caused panic and bank runs. Bank runs are when a large number of customers withdraw cash from deposit accounts with financial institutions at the same time because they believe that something bad is about to happen. President Franklin Roosevelt established a banking holiday, and banks opened when they became more stable. The creation of the Federal Deposit Insurance Corporation insured customers in case of bank failure. It became more difficult to exchange dollars for gold, and fiat became the main mode of currency. This also allowed for the Federal Reserve to control money supply more easily.
The savings and loans crisis occurred due to several reasons. 1. Deregulation, because savings and loans banks were previously protected by the government. 2. High interest rates promised to their depositors, in contrast to the low interest rates promised to the loaners. 3. These banks gave out risky loans which were not paid back, causing many of them to go out of business. 4. Fraud. Institutions deliberately made loans to businesses they knew would be unsuccessful. When these businesses failed, the FSLIC lost much money, and because the S&Ls insure FSLICs, they lost much money. With the creation of the Financial Institutions Reform, Recovery, and Reinforcement Act, savings and loans banks lost their independence and became insured by FDIC.
In 1933, right after the crash of the stock market and during the Great Depression, 2 members of Congress put their names on what is known today as the Glass-Steagall Act. This act separated investment and commercial banking activities. At the time, improper banking activity, or what was considered overzealous commercial bank involvement in stock market investment, was deemed the main culprit of the financial crash. The Glass-Steagall Act was repealed in 1999. Banks could now sell financial assets and allowed for the development of privacy policies.